With a closed-end loan or mortgage, the mortgage requires at minimum a full scheduled monthly payment. For example, let's say that your house payment is $2,000 a month, and you say, mortgage company, I only have $1,000 this month. Can I just pay you $1,000 and you'd be satisfied? Now, how do you think that would go over? Okay. An open-end loan also allows payment in but no withdrawals out. Again, let's say you pay your $2,000 mortgage payment and something comes up and you call your mortgage company and you say, I know I paid you $2,000, but can I have $1,000 of that back because something has come up? Again, that isn't going to fly. Okay. Examples of an open-end loan are credit cards, prepaid debit cards, or debit cards that you can keep applying money to, and open lines of credit. Okay, one of the most common open-end loans are a home equity line of credit, or a HELOC. With an open-end loan, the money will be applied to the loan balance whenever it's received by the lender. An open-end loan has the ability to adjust the principal balance multiple times per month. I'm going to show you how to utilize that second mortgage to save thousands of dollars, hundreds of thousands of dollars even, on your first mortgage. Okay, let's say you go buy a house for $200,000, and that's going to be your principal loan amount. You're going to borrow $200,000 from your bank or your mortgage company or whatever. Okay, the interest rate that we're using for this example is 6%. Okay, a $200,000 loan at a 6% interest rate is going to give you a monthly payment of $1,199. This is a 30-year loan, so we are going to pay that monthly payment for 360 months. When we get through paying $1,199 for 360 months, we will have repaid to our lender or our bank or our mortgage company or whatever you want to call it $431,677. Okay, subtract the amount that we actually borrowed, which was the $200,000, from the amount that we've actually paid back, which means we have paid to the bank $231,677 in interest. Right? So, how to use an open line of credit to pay off your first mortgage or a 30-year mortgage in 15 years or less. Again, this example uses a HELOC, also known as the second mortgage, and the amount of the HELOC in this example is $10,000 as my open line of credit. For the purpose of this presentation, I'm going to use a family monthly budget. And this family is wanting to pay off their first mortgage. They have an income of $5,000 and they have living expenses of $4,000. Now, bank, and you get a $10,000 HELOC, and you decide that you want to go out and have some fun, so you immediately draw out $3,500 to go have a good time. And the only reason that I'm doing this is because I have to have some kind of balance or in my HELOC to show you how this works. And then the next thing you do is you write checks amounting to $4,000 to pay for your monthly expenses. And remember, again, our monthly expenses are our house payment to our first mortgage, any car payment we might have, utilities, the groceries, so on and so forth. So that means you now have a balance of $7,500 that you have drawn out of your $10,000 home equity line of credit. You're going to make a deposit of $5,000 income. Your income is going to be deposited directly into your HELOC. Remember the slide that I showed you? Instead of going into a checking account, you're going to deposit your monthly income into your HELOC, which means you have an average monthly balance for your first month of $2,500. Okay, you have to pay interest on your open line of credit as well. So our interest for month 1 is going to cost us $20.83. Now when you paid this $5,000 payment or deposited your income, that $20.83 is in there already. Now we're going to look at month 2. You have a $2,500 balance that you currently owe. You're going to write out your $4,000 worth of checks to pay month two's expenses. So now your new balance is $6,500. You deposit your $5,000 income, make your monthly payment in other words. So your average monthly balance for month 2 is $1,500, which means we pay interest of $12.50. Of course, that is included in this payment already. When you deposit your income, it's the same thing as making a payment to your second mortgage or your home equity line of credit. Okay, bring your balance forward for month 3. Write out our checks for our expenses. Our new balance is now $5,500. Deposit this month's income. Our new balance is $500. Now, with an open line of credit, you cannot pay more into the open line of credit than what you owe. Same thing with the charge card, if that's your open line of credit. If you only owe $500 and you're wanting to, but you have, let's say in here, you have $10,000 available to you because this is a home equity line of credit for $10,000. That means since you only owe $500, you have $9,500 to use at your discretion. So in order to be able to calculate the totals, I've come up with this figure right here. Just you can pay however much you want to, but in order for this example to work out in the timeline that I want to show it to you in, I'm going to write out a check for my first mortgage in the amount of $3,675.77. This is my extra payment. Okay, now this is a look at our mortgage. This is our timeline for our mortgage, whether your mortgage is 15 years, 30 years, whatever. Here's your first payment, and then here's your last payment. As you make those payments, your interest is going to be greater at the beginning and lessen as you go down to make your last payment. Your principal that you pay out of that first payment is not going to be very much at all. Now remember, you still have to pay next month's house payment, even though that you paid that extra $5,000. All right, but by paying that extra $5,000, you forced your payment schedule to adjust 2 years into the future. See this, all of this principal right here that you paid? That's your $5,000. And since you paid that $5,000, you don't have to pay any of this interest right here. All right. So you've saved yourself $23,000 and you saved yourself 2 years worth of payments. Okay, month 4, you do the same thing. You bring your balance forward, you write out your checks for expenses. Your new balance is $8,175.77. You deposit your income and you pay your interest on your average monthly balance of $3,175.77. Month 5, you write out your expenses. Your new balance is $71.75. You deposit your income, and you pay interest on $21.75. Month 6, you bring forward your $21.75. You write out your expenses. You have your new balance. You deposit your income, your $5,000 income, or make your monthly payment, or however you want to call that. And then you have your balance of $1,175. In month 6, you make an extra payment. Month 7, I think you should be able to get the gist of it by now. You carry forward your balance. You write out your $4,000 worth of checks for expenses, which gives you your new balance. You make your $5,000 payment or deposit of your monthly income, which gives you your new balance. It's just that by using this system, ever so often, you get to make that extra monthly mortgage payment. Now, in just 1 year, you've helped yourself in 3 ways. You've helped pay off your mortgage quicker because you've reduced your mortgage by 53 months. You've helped cancel out interest that you will never have to pay. In other words, you have kept over $50,000 in your pocket. Now, if you use this open-end program to pay off your first mortgage's starting balance is still $200,000. Okay, but your balance at the end of 1 year is $184,811, which gives you an equity balance of $15,189. Now, if you just have your 30-year mortgage and don't add an open line of credit to help you pay off that 30-year mortgage, just pay this straight, you still have a starting balance of $200,000, and your balance in 1 year is $197,543, giving you just a little over $2,000 equity in your home. Okay? Now, it's going to take you 5.5 years to achieve anywhere near the same balance that you can achieve in just 1 year when you use an open-end line of credit to pay off your first mortgage. Okay, your repayment time in your 30-year program without using this program is going to be 30 years. It's a 30-year loan. Okay, the interest that you're going to pay over that 30 years, in this example of using 6% interest for a $200,000 loan over a period of 30 years, is $231,677. Now, when you use this open-end program, you're going to pay your loan off in 10.4 years. By paying it off nearly 20 years quicker, okay, you're going to pay an interest of $70,422 versus paying an interest of $231,677. So when you use this program right here, how much interest have you saved? $167,219. Of course, here's another visual. This is your first mortgage and how it would play out over a period of 30 years. But this is the first mortgage that you get to pay off quickly by having a second mortgage or an open line of credit or a HELOC, but it has to be an open line of credit. Okay, so your 30-year mortgage you get paid off in 10.4 years, and you save $167,219. All right,